Inflation has hit the magic number of 3% according to the latest figures from Stats NZ. We had this yesterday. Big drivers behind this: power prices up 11% in the past year, rates up 8.8%. Cameron Bagrie, independent economist, is with us this morning. Cameron, good morning.
Good morning.
So we're going to look through this and cut rates next month?
I think they'll look through it. Yeah, there wasn't many surprises in the data. Yeah, if you look at a measure of core inflation, non-tradable, which is domestic-driven inflation, if you strip out government charges, that came in around 2.6, so that's a little bit more comfortable within your policy band. But the Reserve Bank still needs to be wary here. Your headline inflation, when push comes to shove, is still 3%, and it's climbed up. And if we get a number stronger than 0.5% for the December quarter, you're going to be in the threes.
Is it more embarrassing for them if they go too hard and then have to pull back, or would it be better to have a stable track?
Well, the risks are two-sided, and that's the problem the Reserve Bank's got at the moment. If you look at core inflation, which is a function of your underlying economy, your core inflation is still coming down because your domestic economy is really weak and you can't pass on price increases. But you've got to be careful how much you strip out of inflation, because inflation is still inflation. And yes, we look at core inflation measures, but the headline rate is still moving up. And if the headline rate remains elevated in excess of 3% for a little bit of time, the danger is that seeps into pricing behaviour. And if it seeps into pricing behaviour, you've got a real inflation problem.
Cameron, there's a lot of blame game that inevitably happens when we see a number go up like this. What do we put it down to? You know, the government said we're going to tame inflation, tackle inflation. And they did. We were back in band. Now we're touching cloth on outside band. Who's to blame?
Well, you can point the finger at a whole lot of different groups. If you look at the underlying economy is soft. So domestic-driven inflation, that's dissipating. But of course, we're going through a bit of an export boom at the moment. So when we go for an export boom in regard to prices, guess what? Food prices go up. So there's a nasty byproduct to a lot of the success we're seeing across the farming sector out there. Government charges are up about 8%. You talked about rate capping. Well, rates are up about 8%. Tertiary education fees, they're up about 22.6%. So within some declining numbers, still got a few crackers that are coming through there, and it all adds to the headline number.
Do you have a view on the rates, Cam?
I can't exactly comment because I might have a little bit of involvement in it.
Okay, they've roped you in to put it together. How do you do it? How do you do it without kneecapping the councils to the point where they can't fund the stuff we actually want and need?
Well, I guess one way to think about this, Ryan, and I've got to be careful what I say, is there any logical reason as to why councils will be getting, moving up in excess of nominal GDP or the size of the economy? So if you think about the size of the economy as being somewhat of a benchmark in regard to how much council growth, council volume and price of spending should be, it probably gives you a bit of a long-run anchor in regard to where you need to be in regard to rate increases versus volume increases in terms of your rating base.
How out of whack with that are we?
Well, at the moment we're at 8 in regard to rates. We have been double-digit in previous years. Nominal GDP for your economy, typically in an average year, is probably going to be around 5.